Hey guys, Jeremy Parvin here. Welcome back to my channel. As you know, I've created a passive income stream of over $50,000 a month in rental property income. My portfolio is worth over $6.5 million. I've done all this while working a full-time job, and on my channel, I'm going to teach you how you can do it too. Okay, so in today's video, I'm going to show you how much my rental properties made after expenses, how that flows through my tax returns to make you money and save you money. By the way, this is a big deal showing this to the world, which I've never done before. I'm sure I'm going to hear from my friends and family about how I'm crazy for disclosing some of these things. The purpose of this is not to brag or anything like that. It's simply to help other people find a way to make some passive income while working a full-time job so they can leave that job or so that they can have a great retirement. I've also got some really big news for all of my subscribers and all my viewers.
So a quick update on the channel. Since last week's video, we've hit 8,000 views. We have over 660 watch hours and 427 subscribers. And also about 77% of our views have been by non-subscribers. So the big thing I want to say to all of our viewers as well as our subscribers is
subscribing to the channel is absolutely free, and liking the videos is absolutely free.
some people really thought that it cost to subscribe. Post a comment on every video to ask me any question that you have, and this is basically free consulting. This way others can learn from your questions, and every time that there's a comment, it helps the YouTube algorithm share this with other people so they can help join the channel. And then here's a quick update on how we're doing towards monetization. We're about 43% of the way there on reaching our 1,000 subscribers. We're a little under that on getting 400,000 views. Something that can help this is I've heard people say, oh, I need to sit down and watch these videos or watch the other videos. And what you can do is actually hit the playlist while you're driving your car.
Okay, before we get into the numbers on the tax return, I want to remind you that I bought 4 properties last year. There won't be 12 months of rent income or expenses since I bought these throughout the year last year. As you can see, I bought about 1 per quarter, one in February, June, September, and November. Generally 3 bedrooms and 2 baths. You can see how much I paid for each of these, totaling $624,000. The FMV stands for fair market value. I simply got this from Zillow not very long ago. You can see the difference there of $743. The next column I listed for you guys, maintenance and repairs, to show you. I bought this one here. Obviously I didn't do much to it. It was ready to go. And then this one here was ready to go as well. It was done by a flipper. This one was a lease purchase, and so they were responsible for doing some of the repairs that they wanted to do, but it was certainly move-in condition. The next one here, I did a big renovation of $45,000. I spent a lot more than I meant to. We had to redo some things. And then I spent a little on this one as well. I spent some additional money on this year actually, but I wanted to show you some numbers that relate to 2020's tax return. The next column shows equity, and it's simply the difference between what it's worth today and what I've paid completely by the end of last year. And so by the end of last year, I actually had an equity position of about $63,000 on the 4 new properties that I added to my portfolio. Next, I listed for you guys how much rent I'm actually getting on these, and so you can kind of see how much rent I'm getting based on what I paid for a house and what a house is worth. And I do that simple math right here, rent over fair market value. And this is something I track on a spreadsheet that I look at all the time when I'm trying to list a property for rent and when I'm looking at my current rents to see kind of who's high and low on their rental rates. Should I increase the rates on existing tenants or when I'm leasing the property again? As you can see here, I'm averaging just below 1% or 0.94% on these 4 properties. This one actually is low and was higher. I had someone move out recently, if you saw my last video, and when I was interviewing prospective tenants, this particular couple I really liked, and right now with the eviction moratorium going on, it's much more important for me to get tenants that are very high quality tenants who I'm confident will pay and who also seem to be a good fit for my home and my rental business. So again, when you see the tax return numbers, it's not going to include 12 months of rent for these 4 properties that I've added to my portfolio. Okay, so here's the numbers off my tax return. So including the 4 new properties that I bought last year, I had a total of 21 properties at the end of the year. I have already bought 2 more this year, and I have 1 more under contract, and I plan to buy as many as I can. This is just my residential rental property. This does not include my commercial property. I thought most of the folks on this channel are probably interested in seeing residential rental property. So I reported on my tax return $367,000 of rent. And then I had $76,000 in mortgage interest expense, $30,000 in real estate taxes, $17,000 in insurance, $4,600 in utilities. I don't pay for utilities at any of my properties. These are just costs with turning utilities on and off and some holding costs while doing some renovations. I spent $114,000 on maintenance, repairs, and improvements. And I want to talk about this in a minute. I spent quite a bit on this. And if you recall, when we were back on this tab, I spent $45,000 in $86,000 for a total of $54,000 on 2 of the properties. So a good half of that is on 2 properties, mostly on 1. So then we have some other miscellaneous things I grouped all together of $9,000, and so that subtotals $252,000. So if you take those expenses off of the rent, you get $115,000 income before depreciation. So you might naturally think that this is how much income you would have, and if you were in the 22 or 35% tax bracket, for example, this is how much tax you would owe on that income. And by the way, rental property income, at least this piece of it, is taxable just like your earned income at your day job, and it's taxed at your tax bracket that you're in. But this is not actually how much you owe taxes on. It gets better. And this is one of the fantastic incentives that our tax system has to incentivize people to take their hard-earned money and invest in this great country and take a chance. Okay. So depreciation. So when you buy property, you simply take the value of the property minus the land and then divide that by 27.5 years. And that's how much annual depreciation expense that you'll get to take on that property as long as you own it, or for the next 27.5 years. So for example, on the 4 properties I bought last year, I paid $624,000. Let's just say that the land was worth 20% of the value of what I paid. And so I'll multiply 80% times that value. That would say we get to depreciate $500,000 over 27.5 years. Then you would depreciate $18,000 more per year. So I use TurboTax, and it calculates the $59,000 per year for me to depreciate on the number of properties I had last year. So now, when you subtract off this depreciation expense, you get to lower your income by another $60,000. This is a big deal. It brings your expenses up from $252 to $312, and so your net income that you're paying taxes on is only $55,000. So if we use a median income of $68,700 and take a look at the federal tax brackets, I guess since we're talking household income, we should assume that they're married filing joint. If the median income is about $70,000 and you made about $55,000 on rental property income, then that's going to put you at about $125,000 a year. If we take a look at the tax tables, you can see that $125,000 falls right in here if you're married filing joint, so you'd be at the 22% rate, or if you're a single, you would be at the 24% rate. We'll do an example with the 22% rate, and we'll take it all the way up to the 35% rate. So right here you can see how much money you would save, $13,000 to $20,000, depending on if you're in the 22% or in the 35% tax bracket. So this is a big deal. Every year, this is cash flow you get to keep and reinvest in your property or go on vacation. Let me come back to depreciation in a minute, because it's not completely free. And let me finish this example here. I mentioned that this maintenance and repairs expense was kind of hefty here, right? Because I did a big rehab. In addition to that, I also did a lot of improvements on my other properties in my portfolio. But I've got 2 more examples I modeled out to show you guys. Oh, I also showed that the $114,000 was about 31% of the rent that I received. So that's pretty hefty. That's not normal. If you didn't spend so much on maintenance and repair, you could obviously make a lot more income here. I thought I would show you this example without that $55,000 in maintenance repair that I did on those 4 properties. So what would that do? That would take it down to $58,000 or 16% of the rent. And that would take your income up about $50,000 to $111,000, in which case your taxes would be $24,000 or $38,000 respectively in those 2 tax brackets, and you would save $13,000 and $20,000 again by having depreciation expense. And then doing that one more time here, let me scoot over here. So I take pretty good care of my properties, a lot more than a lot of rental property managers do, but I think you could probably get down to a 10% of your rent that you receive as the maintenance and repairs. I think that's a very realistic number and still have some well-maintained properties. And this would be more of a steady state. If you're not doing much to your properties, you're just kind of keeping them like they are. So in this scenario, I think you could get that number down to $36,000 and your rent income would go up to $133,000. You would owe $29,000 or $46,000 in income taxes. Again, saving that $13,000 and $20,000. So if you're writing these big checks for $30,000 and $46,000 of income, you're going to be happy you didn't have to spend another $13,000 and $20,000 for that depreciation expense. Okay, so back to depreciation expense for a second. It's not completely free. You get to subtract off of your taxes for an expense that you actually did not incur. You didn't spend cash on it, but for some reason you get to reduce your taxable income by it. Why is that? The concept of depreciation is expensing something over its useful life. So it's assuming that the house has a 27.5-year life. And so each year you get to write off a portion of that. In real estate, houses actually go up in value. You do have to maintain them, but you get to write off the amount of expenses that you pay to maintain them. And so you end up with this extra depreciation, right? Well, it's a fantastic tax benefit, but it's also not completely free, but it can be. It postpones you from paying taxes now, but you may have to pay them again in the future whenever you sell the property. Another fantastic thing that it does, and this is another real estate benefit, is that if you sell it later and pay taxes on it, it's not going to be your tax bracket rate or your earned income rate. It's going to be at a capital gains tax rate, which are some of the best tax rates in the tax table. And so the difference between a capital gains, it's an asset that you buy, like a house or like a stock. Our tax code incentivizes investors to take a risk and to buy assets like that to help the economy and to provide jobs and housing and money for companies to help our economy grow. So when you sell it, you'll pay capital gains on it. So basically the amount of depreciation that you write off over the time that you hold that property, you'll pay taxes on that amount in the form of a capital gain whenever you sell it. So check out these phenomenal rates. So this is for single filers, married filing joint. So you're looking at 0, 15, or 20% long-term capital gains. Long-term means you hold it for more than a year. So these are generally significantly less, if not half or so. And you heard me say you may not have to pay tax at all on it. That is the 1031 exchange. You heard me talk about that also in the video I did recently. I'll put a link up in here, that the current administration is working to try to significantly minimize. This is something that's been around for real estate investing for a very long time, that allows you to sell a property and postpone that gain by buying another property and not paying any tax on it now, just rolling that forward. And the part that I alluded to about not paying taxes ever on it, if this property is included in your estate, currently the capital gains that you would owe on that property are forgiven, and your heirs will receive that property or that house at the value that it's currently worth, and they don't have to pay any taxes on it. Instead of inheriting your tax basis or all that capital gains tax that you should pay, it gets wiped away upon your death. This is something that the current administration is trying to get rid of completely. So if you inherited your parents' house or farm, for example, today you would most likely get it and not to pay any taxes on it if you sold it and split it among the children. And in the future you would have to sell it, and property is worth a lot, and so it would probably be in a high tax bracket, and after selling it and paying taxes and the other associated expenses, you would probably have a pretty small portion, half or something, left over to split between the heirs, as well as to pay off the estate. So you might be thinking, wow, this guy has $6.5 million of real estate and he's only making $55,000 a year on this. Why would I bother? Well, there are several ways that you make money in real estate. If I want to lean my current portfolio down, I could be making a lot more cash flow. But the other thing I want to remind you of are some of the other ways that you make money in real estate, in addition to the cash flow and the tax savings that I just mentioned. You also pay these loans down every month, and the properties go up in value through appreciation. So I made a quick 10-year example, and let's assume that the portfolio is worth $6.5 million. Let's assume that the value of properties go up by 5% or maybe 10% a year, and let's grow that or compound that each year. And so you can see after year one, this formula is simply the sale above it times 5%, right? And so this one grabs the one above it times 5%, and you can see the compounding effect at just 5%. In the last 2 years, the county I live in, tax assessor said they've gone up 15% both years. That's a lot. Zillow has been saying 10, 11, and 12% in all the counties and zip codes right around where I live, and I completely believe those are good numbers. Obviously those are high and those are not very sustainable, but I think that a 5% is something very realistic. And so this is just an example to show you how quickly things can grow with compounding. And so a $6.5 million portfolio today will turn into 10.8 at just 5% growth, or $16 million at 10% growth. So in addition to this appreciation, you're going to be paying them down, you're going to be making cash flow every month, and you're going to be saving on your taxes. So that's 4 ways you make money in rental property. Next, I wanted to show you guys a more realistic. Next, I thought I would show you guys an example of getting started. If you bought a $250,000 house, maybe you live in this one, you're going to make it your first house. Or maybe you buy 2 rental properties that are worth $250,000. But I just wanted to show you the same example of how much it would grow to through appreciation over a 10-year period at both 5 and 10% growth rate. And so the difference will be all appreciation. Next, you see it at $500,000 And then you can see what $1 million turns into here. Let me throw some quick formulas to show you that difference. Boom. So you can really see this growth, and these are very exciting to me. So a $4 to $10 million growth over 10 years in my portfolio is very realistic. And just getting started at $250,000, you can see how you would gain 150 to 400,000 there, and then taking that forward, if you just had 4 of them, you would get to 628 to 1.6 million dollars. Okay, so since we're talking tax returns, I thought I would show you the stocks that I sold last year. This is a little embarrassing. These are also capital gains. Like I mentioned, those same rules apply. Okay, and let me say, first of all, this is only my taxable brokerage account. This does not include my IRA or 401k because those things don't show up in your taxes. So I sold 6 stocks last year, and I made money on 5 of them. So Zillow, I made about $6,000. Walmart, I made about $2,400. Southwest Airlines, I made about $1,000. Delta, I made about $1,600. Facebook, I made $6,100. But Macy's Inc., I lost $22,000. That totals up to losing $5,000 last year. So I spent $82,000 buying those stocks, and I only sold them for $76,000. That's so embarrassing, but also I really wanted to share the truth with you. You'll hear people talk about how much money they make in stocks, but you probably don't hear a lot about how much they lost in stocks. So I kind of wanted to show you the good, bad, and the ugly here for full transparency. A couple of other things I was doing last year is we have a wealth manager that we use, and they were really encouraging. We went to a seminar. A couple of the things they really stressed to me was to not taking so much risk in single stocks. And I know this from my days in college. I kind of like doing stocks. It's something I do a bit for fun. But one of the things that they suggested was to not play the stock market, to not buy individual stocks. It's too risky, as you can see here. And to just play the market in general and buy a big basket of the top 500 stocks known as the S&P 500 index. And so I did some rebalancing last year, and you see me selling Macy's there. Taking that loss, I can use that against gains that I make when I sell houses, for example, or other stocks. Or if I don't make any losses, I can use 3,000 of that per year and carry that forward. And TurboTax does this automatically. But I just wanted to show you down here quickly, FXAIX is the Fidelity 500 index fund that I tell my friends and family to buy. And last year I made $57,000 in that fund alone. I also made $32,000 in another mutual fund that contains multiple stocks. I still have some single stocks left in my portfolio. Some of these are some other dogs that I'm just holding on to. Well, American Airlines, I'm down about $2,000. Tilray is a marijuana stock that I'm down $26,000 in. VDE, I'm down $4,000. And CBL, I'm down $39,000. It's a local publicly traded company that owns a lot of malls, and they went into bankruptcy. So when I go to sell another house, I'm gonna dump these 2 big stocks, and I'll be able to offset gains on those houses with these losses. But since my tax return looks so bad from the stocks that I sold, I wanted to show you what I did on my tax return in 2019. And so I made $1,600 on Align Technology, $4,500 on Apple, $3,500 on CarMax, $7,500 on Facebook, $7,600 on Fred's, and I made $14.7 thousand on Tesla. I want to say the previous year I made 30 or 40 from Tesla. And so I netted a total gain the previous year in 19 of 39.4, so I don't always lose money. I will say this though, I've made money in the stock market and I've lost money in the stock market. I never lose money in real estate, and it's certainly my favorite asset class. However, you should have a diversified portfolio with stocks, real estate, and things like that. In addition to these couple of asset classes, I also have an equity position in 2 medical entities. The biggest thing you can do to save money on your taxes is to smash the like button for the YouTube algorithm. I hope you enjoyed kind of seeing some of that, how the sausage is made, seeing some of the tax incentives for real estate investing in play, how depreciation expense saves you on your taxes. It defers it until later, changes it for being earned income with your tax bracket rate into capital gains rate, which is significantly less. You can roll those gains forward into future properties through 1031 exchanges, and you can even take those into your estate if you want to roll those forward and possibly eliminate any capital gains or taxes on them completely. Please ask any questions you have in the comments for free consulting, and I'll answer you there. And please help us get some more subscribers for the channel to continue this great growth.
Each time you like, share, and comment, it enters you for another chance to win one of our AirPod Pros that Lily has given away to one of our first 1,000 subscribers. Thank you.
Oh, and by the way, even though I am a licensed CPA and have 3 business degrees, I'm just a guy on YouTube with my dog, so please be sure to consult your professionals before making any investment decisions.